Now it's driving towards unicorn valuation. I'm going to introduce Victor Boyajian, heading Dentons Global Venture, Technology, and Emerging Growth Companies practice worldwide. He's recognized from his deep network of relationships in the tech ecosystem, and his clientele reflects a cross-section of sectors including fintech, autonomous vehicles, AI, robotics, digital health, big data, cloud software, digital media, mobile, internet, e-commerce, quite a lot. Victor has been an adjunct professor at the University of Pennsylvania Carey Law School, where he lectures on entrepreneurship and venture capital, and he has been recognized by Chambers USA as one of the leading practitioners in the sector. Welcome.
Thank you. Appreciate it. No, this is very good. I think we're mic'd up. Excellent, thank you. Thanks for the introduction. Whoever wrote it, I appreciate it. I think we'll have some fun on our panel exploring some themes that I think you deal with every day in your work life. It's very important that we get these issues out there. What we're going to try to do is understand what brings corporates to the table, what your thesis is for entering into the marketplace, but then really trying to understand what's on the other side. What is of interest to the financial players who might be on the cap table already, as well as importantly, the company at large, including, of course, the management team, the CEO, the founders. And I think if you can really get that alignment straight, that's where you're going to drive the most valuation. If the alignment's not quite there to start, or it's started properly and moved in a different direction, that's where it'll directly impact valuation, if you will, ultimate valuation. Why don't we do an introduction, of course, of the panel. Paolo, why don't you introduce yourself and the fund, the company?
Yeah, thank you very much, Victor. So my name is Paolo Bavaj. I work for Henkel Tech Ventures, actually running the fund, Henkel Tech Ventures, which is the corporate venture capital arm of Henkel Adhesive Technologies. I have a colleague who is running Henkel DX Ventures, taking care about our fast-moving consumer sites. Together, we have about 300 million euros under management. We strive for mainly for startup collaborations. We are a strategic investor, of course, and in some of the collaborations, we are also investing. And we do in Henkel Tech Ventures anything around material science, new formulated engineered materials, digital business models related to those materials, and we have our own internal accelerators, which we also support through our venturing activities.
Great. Valentina?
Valentina, Shegoyan, Second Century Ventures. We are a US-based fund, founded back in 2008, fully backed by the National Association of Realtors in the States. So we are looking for technologies that help real estate as an industry, and we are doing so for a while. Now we are global as well, so we have operations in Australia, Canada, UK, in addition to the US. And since 2012, we also do an accelerator. So for us, it's important to be that bridge between the technology startups that we are investors of into the industry, which is totally standing behind innovations. We have more than 150 companies in our portfolio, so some of them are probably naturally bring as examples when we start the discussion.
Great. Jess?
Hi everyone, Jess McCreadie, here from Octopus Ventures, which is a pan-European venture capital fund. We invest across all parts of software and innovation. I myself focus on health technology. Over the years, we've supported over 160 companies and managed just short of 2 billion sterling as at today. Previous to joining Octopus last year, I'd set up and led the health technology team at Legal & General. So of interest, the discussion today wore the hat of a financial but also a strategic investor in that role, where we're investing in health technology in order to try and improve health expectancy of the broader organization's underlying customer base.
So why don't we jump in? And my focus has been representing both the company side, the founders, helping them grow, but also the money, right? So both the private equity, the venture capital, and the corporate. So it's an interesting perspective. And it's not only just on the investment side, but it's on exit. So I'm hoping to infuse some of that into our discussion and also perhaps represent the interests of the founders as we're talking. Paolo, so just tease out a bit more as to what you're looking for when you're investing. Like, why are you doing what you're doing?
Yeah. So in our mission in life is to build new Henkel businesses based on the technology or the application or the business model of a startup company. That's in the end what we would like to do. So we separate between two different horizons. One horizon is to strengthen the core business. So we need to make sure that we always use top-notch technologies and that we, also catch any potential disruption from the outside early on, and then more embrace that disruption than trying to avoid the disruption. So staying strong in the core is one of the aspects. The other aspect is then how do we grow beyond the core? And here we have two different variations which are not always easy. So the easy part is once Henkel decided, for example, we are the market leader in maintenance, repair, overhaul. So it's clear that the topic of predictive maintenance becomes super important there. So it is kind of a corporate strategy to grow beyond the current little red Loctite bottles which represent our MRO business into a more digital business, predictive maintenance. And then we actually can support that with startup companies, mainly for sensors and artificial intelligence. The difficult part is where we, from the team, see that there is a trend, that certain industries are developing in a certain direction, which the company might not have fully embraced, not fully gotten the point. And any strategic development process in a company is a longer process. It needs alignment. And so when we see these things, we try to bring that, we bring that up to these guys, and we inspire them, hopefully, by these trends. But it's not that easy then to do an investment in these areas because they are not necessarily supported by the operating business. And so as a consequence, they don't necessarily provide the resources to collaborate with that startup. And then we end up as a financial investor and lose the strategic element, which is something we don't want to end up.
So I'm going to ask the same question to Valentina, but before I do that, so how do you take that knowledge you gather from the marketplace and bring it back into the company, putting aside companies that you invest in?
You mean to our company?
Yeah.
So that is something where we thought intensively about 3 years ago. I mean, as we all here, we also meet every day super interesting people. We see super interesting technologies and breathtaking business models, and we learn every day. And so also our question was as well, so how do we make sure that the organization learns with us? How do we make sure that not just we learn, but that entire Henkel will learn? So we do basically 3 things. One thing is webinars. So whenever we see something which is super interesting, where we have also invested in and so on, we do a little webinar with that company to make sure everybody in the company knows what this company, what the startup is doing. Then we are sharing every year the top 50 companies from our deal flow in a kind of database tool with our colleagues. So everybody in Henkel can access that tool, and they can find a non-confidential pitch deck. They can find a small summary, the link, how we see the link into the operating business, and a contact in our group. So they can then contact us and find out more details if they're interested in. And the third aspect is we have what we call Tech Ventures Week. It's like a 3-day event. It's not a 3-day, it's 3 days, but only 3 hours per day because, we are a global company and we need to make sure that we don't lose the colleagues in the different time zones. So it's our Tech Ventures Week, where we bring in keynote speakers to really, enlarging the mindset of the people, broadening and enlarging the horizon of the thoughts of our colleagues, inspiring the colleagues. And here we also talk about new startups, and we talk about the operating business is then talking about their experiences in collaborations with startups. So it's basically, you know, much more powerful when colleagues talk to colleagues instead of us talking to them. And this is actually what we are doing. We are trying to facilitate that peer-to-peer conversation within our organization about startups, and then, you know, spreading the word and in the end, driving a cultural transformation process in Henkel.
So Valentina, Paolo mentioned, I like the phrase catching disruption, part of his, you know, trying to identify trends in the marketplace. So again, I want to ask the same question. Why are you in the marketplace? Why are you doing what you're doing?
Yeah, so when Second Century Ventures was set up at first back in the way, the key mission was to help real estate practitioners navigating through the world of technology and finding the right tech tools that would help the industry. Then we are talking about thousands of startups by now per year that come through our door. So arguably, if you are in business, if you're in the industry and it's not your main business, that becomes overwhelming. So you do need someone who just daily job is to meet companies, meet innovations, and see whether there is potential. Now, I came to venture from the industry myself, so I was in real estate for 15 years. And we do also have similar problem as Paolo just described, where you know that that's the right tech tool, but the industry doesn't quite pick up on the trend. And what we figured, it's not quite the disconnect between their content, it's disconnect between how their technology is being positioned and explained to the industry, and industry and people on the tech side not speaking the same language. So that's why in 2012 we set up an accelerator program, and what we do, the way we solve this problem, we find mentors from the industry, and then we brief mentors to talk to technology companies with an open mind, not to just sit there and listen to the pitch and then saying yes or no, but quite the contrary, to become a stakeholder of the business. Be brutally honest as to that their product doesn't fit the business, but then allow technology company or the startup to go one level deeper, explaining what their stack actually can do, because that's when the overlaps start happening, because that's when, by brainstorming from both sides, all of a sudden the technology is right, feature is wrong, or the way it is presented is wrong, and it's way too easy to just stop the meeting then and at that moment in time without exploring. And then when the exploration starts, then all of a sudden there is a use case, there is adoption, there is growth potential for the startup, and then we are a financial investor, so we are there for returns. We're a VC fund, so it of course benefits us, but all the interests are aligned this way. So that's how we deal. And that's
so just assume you're on the cap table to start. You're the first in on an A round. What's going through your mind as you think about whether it makes sense to bring in a corporate or to support one of your CEOs who is interested in bringing in a corporate that she has been tracking herself or she has bumped into at a conference, et cetera, et cetera?
Yeah, I mean, lucky enough that we've had some fantastic experiences of strategics investing in our portfolio companies. Where it tends to work best are when the structural components of the contracts and the legal docs are aligned up front. So making sure that when conflicts do arise, there's a way to call them out, recognize them, and then work through them on a collective basis. I think where we've also found it works particularly well as if a company gets involved as a strategic investor once the product is suitably far enough advanced that the investor isn't necessarily influencing the product. Obviously, the early on product set is the most crucial from a cash perspective. And if that product is just being influenced by the strategics that are investing, then it can have sort of constraining impacts to the company. Likewise, it depends what the business is doing. If it needs to have strategic input in order to get that product fit for market, there's also been instances we've experienced where that can be incredibly valuable. But where we, I guess, get most excited as a financial investor is when strategics are getting involved in our companies, when they're starting to think about route to market. I think from my experience, that's when actually the relationship has been most valuable. And certainly setting up front what the expectations are is crucial. So making sure that nothing is left unsaid, but also not too much is overpromised and underdelivered is crucial to making sure that the relationship works well. And from my own experience on the other side, wearing a strategic hat as well, for us it was always an intention to help and facilitate rather than, we will deliver X amount of revenue over X period. It tends never to work or come to fruition, which is always the level of uncertainty you're dealing with early stage companies. So I guess a couple of reflections there in terms of timing, the level of help that's delivered, and then also how you best set up the contract and structure to avoid conflicts from arising. There's many different ways as well on the conflict side to sort of structure and avoid for them and facilitate for them. Certainly we do see examples of sort of upfront agreeing where potentially the areas of sensitivity may arise, and then it's usually with the board and the board voting on a majority basis to decide actually yes, this area of commercial discussion or this area of exit potential is suitably sensitive that the strategic should step out of the discussion at that point.
So just to drill down a little more, and I'm happy to have you join the conversation as well, in terms of setting up those expectations relating to when best to tap into the experience of the corporates, where do you think it's best suited? Is it, you mentioned product.
Yeah, I mean, it very much depends on what the company is doing and trying to solve for. If the high level of IP and problems to be solved for is in the product, and actually, there's a software team within the strategic that can be actually incredibly useful to that problem being solved. We've certainly had very positive experiences of, the strategic getting meaningfully involved. The added advantage you have there as well is that strategics often have a huge wealth of human resource that either cannot or do not want to bet their careers on earlier stage companies, and certainly sort of access to talent pool, particularly within software developers right now in the market, given how competitive it is an area that actually that sort of value add and help can be really valuable. I guess the reflection on shaping the product is more, and it comes back to conflicts and priorities, but if the strategic is wanting to shape the product such that they are the perfect customer for that product, then you're in a way shaping the business to be a captive business of the strategic. Whereas as a board, your fiduciary responsibility is to act in the best interests of the company on which you're representing. So as board members, we should always be thinking, okay, what's the full art of the possible and what's the optimum product to address the total market need, not just one customer.
So how do you, I'll pose it to both of you, how do you balance that need to make sure that you are fulfilling your internal mandate, but to make sure that you're not creating inadvertently or intentionally, I suppose, a captive, if you will?
So so when we invested to a startup, the prerequisite for us is that we also have a collaboration with the startup. And for us, the collaboration path and the investment path are two very separate paths. So we do, from our group, from the venturing team, we do the investment path, and the operating business is doing the collaboration path. And of course, we update ourselves about what's happening and if it's going well or not so well, but we don't really exchange the details. In particular, we don't provide the details from the investment side to the colleagues from our operating business. So we make sure that we can, from the operating side, use the technology for the innovation we would like to realize in Henkel, and on the other hand, that we provide the customer access for operating business, for customer feedback, for POCs, for maybe even first sales through our operating business. But on the other hand, we are making sure that from the investment side, when we sit on the board, we also think a little bit, like Jess said, a little bit further, right? So what is the end game of the startup? What else do they need? Can we organize help, which we cannot provide with our operating business, but which we can provide through our network, and then we provide that help. And but I have to say, since we have a relatively focused operating business, of course, the strategic help we can provide to a startup is always linked to that. So it's not indefinite. So we cannot do all kinds of stuff for them. There is limits to what we can do in terms of, provide in terms of capabilities. So, and this is why we love when we invest to syndicate with other people in order to complement these skill sets, to be, be honest to ourselves. how can we help them and how can we not help them? And in the cases where we cannot help them, do we know somebody who could help them, who could join us for the investment? And that could be, of course, financial VCs, other strategic investors who are on a different level in the value chain, for example. So that's syndication is super important for us to organize that, and also to, as I said earlier, to fully leverage the strategic advantages to our operating business. Two passes.
So Valentina, are you just picking up on these two themes? On exit, are you neutral, or do you prefer to have classic blocking rights, so that you have basically the first right to pick up the company for the operating side, if you will?
So no, it's a big issue for the startup to sell into corporate because potentially it's a huge risk. So in our case, it is cured through the style of the investments. We only invest in minority stakes initially, and then we also do syndicates. So we invite other investors because we see ourselves as, we have fiduciary duty to the industry as a whole because we are backed by the association. So association means there are a lot of members from all sorts of corporates, and that's ultimately who we serve, the members, not the association itself. So it's a little bit easier for us, although we did acquire a couple of startups 100% through the years, but it's only 2 out of 150, so I believe we behaved. Their incentive for us as a team is to grow the company to the unicorn status. So also it's kind of, we are remunerated for financial results more than for their direct benefit for our backer, which I guess helps. It's very similar to what you're saying. So the investment team is separated. So that's, that creates better trust and trust relationship with our portfolio companies. And on their, to add to objectivity, on the board, when there are inbounds from our companies for better connectivity within the industry, so we would go to other industry players as well and introduce the technology even if they're not in our kind of LP pack, so to speak. So that's sort of skewed through the investment style.
Jess, what would your reaction be generally? Would you be permissive and allow a corporate to come in if there was, I'll call it just broadly, a blocking right on exit? Or do you want a neutral playing field or an even playing field?
Yeah, so I guess all blocking rights aren't born equal. So you can have like right of first look, you could have right of first refusal. I guess right of first refusal is like incredibly aggressive and in a way could hamper a sales process, which, you know, from a financial investor's perspective, we want the best for the company, which, you know, has a large financial component attached to it. I think where the strategic value was very obvious and we were, I guess, incredibly sold on it as a team, it's often quite difficult to have that conviction at an early stage. But I guess there would be reasons why you'd be perhaps more comfortable with certain privileges or permissions. But certainly the most aggressive form being an absolute, you know, right of first refusal, but we tend not to see and financial investors tend to steer away from. So the way that both of my co-panel members have set it out, I think is an example of best practice, having like two independent sort of hats within the same strategic, where you have, you know, a team that are responsible for commercial collaboration and scale up, and also a team that are wearing the hat of, you know, the classical investor, is the best way to avoid conflicts. And certainly as a financial investor, what we'd love to see if a corporate was joining the cap table.
But the conflict is certainly there, right? So, I mean, of course, as you said, I mean, when we invest into a company, we invest according to market standard terms, and there are no special rights for us. But through the collaboration, I mean, we team up very closely with that startup, and there is a emotional bond between the involved Henkel people and the involved startup people, which is very strong. And this makes it probably difficult for a direct competitor to acquire that startup, because he would acquire that emotional bond as well. So I think from a legal perspective, everything is all right, but I think from a human factor, soft skill, emotional perspective, there might be a problem, which is, I think the
most important thing is to make sure that when you go to market on the exit, that you're able to conduct an auction, right?
Absolutely.
Because at the end of the day, if you can't conduct an auction and do a market check, whether it's a limited market check, which is narrowly focused, or something broader, it's difficult to sort of, again, ascertain what the true value is, which as an early investor or subsequent investors on the financial side are going to struggle with.
Completely.
It's too hard to do a discounted cash flow model for a company that has no revenue yet or has not breaking even.
In material science, at least our observation is that the management of the startup is emotionally very much linked to their technology. And they really would like to see their technology to become a market standard, the large technology in a particular industry. So they need a company for, who acquires them, which allows them to make that technology a market standard, because the startup is not able to do that. And the risk that they are bought from some competition, which is that's putting everything into a drawer and letting the technology die, is also so. And this collaboration actually is a assurance to the startup that if we would acquire them, we would also further develop the technology and make it a market standard. So this is what I'm saying. So there is there is that legal aspect, but there is also an aspect besides.
There's also as well a worser case scenario than what we've touched on, which is a strategic investing and having a refusal on sale, a right of first refusal on sale, but actually for reasons that maybe their strategy has changed, like some of the team members might have left, risk appetite might have changed, and actually that strategic value doesn't come to fruition for what can be a long list of reasons. But come the exit opportunity, there's still quite aggressive blocking rights there, when actually the company's not had the benefits of a strategic, but is also hampered by some of the more constraining factors that the market consider to be. And that, as well as obviously as a financial investor, would be the worst possible outcome of all options.
So I'm going to we're running out of time here. He's happy I acknowledge that. In 15 seconds, just give me the biggest pitfall to avoid based on your experience, whether we touched on it or not in this conversation. If you're sitting in the seat of any seat, the corporate, the financial, or the CEO.
I would say that for CEO is to underutilized relationship and not being open enough. So I would say that as a CEO, I've just recently heard of this concept, which I loved a lot. Radical transparency with the board and with your stakeholders help a lot, because in the end of the day, you don't know what people or investors at the cap table can ultimately be helpful with. With the National Station of Realtor backing, we helped one of our startups that ultimately reached the unicorn status with government lobbying. Who knew, right? So, and that was Notarize, a company called Notarize that does notarizations online. And when we invested into them, that was only allowed in one state, in the US. And then within the next 12 months, we unlocked further potential for the company through the US market. So radical transparency, know your stakeholders, and as you said, be able to communicate your needs clearly. So
anything to add?
Fully agree.
Yeah, expectation management and communication is typically where things fall down. I'd say that's the number one for us.
Great. Well, thank you all. I appreciate you joining the panel. Pardon my jet lag from San Francisco. I just got in, but it was enjoyed the conversation. Thanks all.